Let's bring in a couple of other voices now. Liz Young of SoFi and Malcolm Ethridge of CIC Wealth. Malcolm, a CNBC contributor. It's great to have you both.
Good to be here.
Liz Young, you heard Liz Ann. What do you think?
Hi, Liz.
Well, hi, how are you? Good. So what I think is happening right now with this rally is that there's a little bit of a game of put the money back where it came from. And a lot of this has been macro-driven. And Liz Ann mentioned that it was multiple contraction. She's absolutely right, because earnings have held in there, if not gotten better as far as expectations go. So this was macro-driven by rates. This was macro-driven by geopolitical risks rising and by people worrying that it was going to threaten this cyclical recovery or cyclical expansion that we had traded into for the beginning of the year. So a lot of that was given back. And now you're seeing this rally over the last couple of days in semis. You're seeing it in banks. You're seeing durables. And you're seeing it in small caps. Again, I think that's because rates sort of stopped out. They stopped rising. And because we have this relief that, OK, the geopolitical tensions didn't escalate into something larger and spread across the globe. What I'm worried about at this point is that I think the market is so short-term oriented that we are hanging on every bit of data. We are hanging on every word of the Fed because we don't know what's going to happen with. And I'm not sure that it matters whether it's September, November, December, or 2025.
I almost feel like we've come to peace with the idea that the Fed's not going to cut rates anytime soon. As long as rates right now are stable and don't continue to back up, I would almost take the other side of that and suggest that we've gotten okay. We're tired of the Fed speak. Let's just carry on with a good economy like Jamie Dimon was talking about today, and Liz Ann agreed with that sentiment on the economy. And that's fine as long as earnings stay well and the economy's good.
That's the key, that last part. We are fine with them continuing to push cuts back as long as the data stays how it is. And as soon as the data turns, if it does turn, the longer they keep rates high, it will slow things down. It just hasn't materially yet. If and when the data does turn and cool off, that's when I think markets will start to grapple with, what is it too cool? Are we now turning in the opposite direction? And if they come in with cuts, the timing of that is going to matter, because if inflation isn't solved, then it reignites everything too soon. So I think you're absolutely right. We're over the Fed speak, and I think that's a good thing, but we're over it as long as everything else is held constant.
Sure. Well, I mean, the economy is not going to all of a sudden fall out of bed tomorrow, right? I mean, earnings expectations have come down, but they're still expected to be positive. Now the bar is so low, it doesn't seem that difficult to leap over it.
In earnings or in the economy?
The earnings bar.
Well, the earnings bar for Q1 never really was all that high. So, I don't think Q1 is very much about what actually happened in Q1. I think it's more about looking forward for the rest of the year, and can we justify these valuations based on what CEOs are saying is going to happen for the rest of the year? And I think companies will get overly punished if guidance isn't raised like it's been raised for the last 12 months or so. So I think Q1, the hurdle is low, but it always was low. I don't think it's about the actual results as much as the guidance for 2024.
Malcolm, Goldman says we're still vulnerable. Barclays says to fade any bounce to position for higher yields. Heard what the two ladies have to say. What's your view?
I'm not so sure we're going to see cuts at all. And that's basically where I've gotten to, because I want to consider what else is on the table. Besides just the inflation conversation, there's an election that's going to happen later this year, right? And what we have to keep in mind is that the Biden administration has a conflicting goal at mind right now with Jerome Powell. Jerome Powell cares only about inflation. The Biden administration is focused on jobs as well. And as long as jobs stay strong, it's going to stay a problem. But if you're a sitting president who's looking to get reelected, you have to be focused on keeping that jobs number and the employment rate up more than you care about getting inflation from 3 to 2, because consumers aren't really going to notice the difference between 2 and 3%. You're going to notice whether you have a job or not. And I think that's the part that's really going to come in and make a significant difference about whether Powell actually gets to cut or not. Because if we don't get any cuts by maybe July, how can you start to initiate them then without it looking political, which we know that Powell wants to stay away from?
What if we don't need to worry about cuts until later in the fall? I mean, let's take the Fed chair at his word.
Sure.
When he suggests over and over that, they're not going to be political and politics are not going to have anything to do with it. Let's just assume we believe him.
Yes.
For the argument's sake, even if you don't.
I don't, but I'll take I'll take that you just gave me, and I'll say that.
Feel like we need rate cuts?
We need it in certain parts of the economy, right? You mentioned earlier small caps. And we mentioned earlier that, mega cap tech is kind of the rotation back, as Liz said, put the money back where it came from. For everybody else that's not a mega cap name, I think interest rates are actually going to matter. Goldman put out a piece earlier this week talking about how within the Russell 2000, I think it's 20% or so are at floating rate. Within the S&P, it's only 6%. And so if you just consider how much is at risk, the longer we go higher for longer, you have to start to wonder, when does the reckoning start to come? And I think that does happen later in this year.
Sure, but Liz Ann, you made the point that there are a lot of other areas outside of mega cap tech and outside of the small caps and the 1,850 stocks you said were in that index that can still work, even in if you want to call this a high rate environment, fine, 4.5% on the 10-year, whatever, but sounds like you would take the other side of Malcolm's argument.
Well, I think you want to stay up in quality, and that's been a mantra of ours for some time. And that may seem like an obvious statement. Why would anybody ever want to be in low-quality companies? But there is a point in the cycle where there is leverage to a big turn up in the economy, a move down in interest rates, often when you're coming out of a recession, where it does make sense, at least for a short period, to go down the quality spectrum where there is that leverage, go into negative earnings territory. Clearly, I don't think that's the part of the cycle we are in right now. So it's sort of this mix that we have of the sector biases that are more traditionally cyclical, but staying up in quality, looking for strong balance sheets and high interest coverage and strong free cash flow, and play it in that combination of both sector analysis as well as factors.
Malcolm, you're the one who's heavily invested in the mega cap names. So you need these stocks to continue to be standouts. You think they will be?
I think we have to consider that investor psychology has changed, right? Where we normally would think about safe havens as things like staples and treasuries and maybe utilities. We're now looking within mega cap tech as our safe haven trade. That's why we're putting the money back where it came from. And I think we have to recognize that investors don't really care about the 10-year yield being at 4.5% or even 5% for the entire year if I can get that in every quarter within the S&P. And the major S&P constituents that are, to your point, helping my portfolio are those mega cap tech names that we're so focused on this week. And I think that's where the market has shifted, even though we want things to go back to the way they were. I just don't think near term that's the market we're going to get.
You continue, Liz Young, to make the argument back towards the short end of the curve. Right?
It worked today.
You wanted people to buy the 2-year some 6 months ago, and the stock market went off to the races, and here we are again, and you like that still.
Well, I continue to believe that we are in an elongated late part of the cycle. So what do you want in that part of the cycle? You want large cap, you want dividend paying stocks, you do want treasuries, because at some point, if either the economy hits the skids, people get scared, or at some point the Fed normalizes policy, yields are likely to come down. We also had done some analysis last week on what's the upside risk in yields in the 2-year from here. And it turns out that the upside risk is lower than the downside move could be, given all the uncertainty that's out there. So I'm willing to stomach a little bit more move up in yields in the 2-year in order to benefit from it on the other side. I'm confident that sometime in the next 2 years, the Fed will have to cut rates. So that's where I sit.
I think most people would be in your camp on that. I enjoyed it, everybody. Thanks so much, Liz. We'll see you, Malcolm and Liz Young, back here as well.